Breakouts to avoid. If breakout trading was easy, everybody could do it. All you would have to do is just buy a stock anytime it made a new high. But unfortunately, it takes a little bit more practice. It takes a little bit more nuance. So we're going to have a section here where we talk about what trades to avoid. Because over trading too many stocks, buying too many breakouts is something that could really, really hurt your profitability. So it's important to also look at when are we going to see a setup that we're going to avoid. First category, downtrends. We always avoid stocks that are in prolonged downtrends, even if they start to move higher. We want stocks that are close to their 52-week highs. And we're going to avoid stocks that have a lot of price bars on the top left of the chart. This is called overhead resistance. And we want to see the current price near a 52-week high, and we don't want the current price to be at the bottom of the right side of the chart with loads of resistance on the left side of the chart. So let's take a look. So you see here lumber liquidators here. Some people would get confused here and say, oh, this is a breakout here. Here's a little bit of a pattern here and it breaks out. But the problem is we have all this overhead resistance over here. And you see, this is a stock in a prolonged downtrend. Look at the 40-week moving average here. Down, 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 down. We don't want stocks like this. Stocks are going down like this for a reason. Look at this thing. It went from 42 all the way down to $10. Okay, this is a stock that we want nothing to do with. It doesn't matter if there's tight closes here. It doesn't matter if there's a hammer candle here and there's tight closes. This stuff doesn't matter. What matters is the long-term trend. So if ever you see a stock in a long-term trend like this, don't buy it if you see it breaking out like this. It's not worth it. There are other stocks that are better opportunities to be in. So the first category is stocks in long-term downtrends like this. This is a stage 4 downtrend here, 10-week below the 40-week. Avoid this type of stock. Avoid this type of breakout. Another thing we want to talk about, we don't buy just any stock that makes a new high. This is something that I made a mistake when I first started. I buy any stock that was making a new high, and a lot of times what was happening was these stocks had already broken out a bunch of times. The stock was way extended. Everybody knew it. Everybody saw it. And I just say, hey, you know what? Let me go buy this stock. So that's not what you want to do. You don't want to buy stocks that are way extended and you're like the last person to the party. The other thing you don't want to do is you don't want to buy lesser known stocks that are not really true innovators when they break out. You want to buy the best stocks that are breaking out, which is going to be the first stocks to break out. And the best time to buy breakouts is the stocks that are breaking out right as the bear market is ending, right as a deep market correction is ending. This is going to be when the market is in stage 1 or just beginning stage 2. So that's the best time to buy breakouts. There are other times in stage 2 when you could buy, but the sweet spot is going to be right as the market's bottoming and as stocks are breaking out and the market's going to be in stage 1 or maybe entering stage 2. I prefer to buy stocks after 3 p.m. to prevent false moves during the early hours of the trading day. So you're going to see, we spoke about this in other sections, but I just put it here to review. You really want to wait till later on in the day to see the volume, to see the price action, the closing price. The price later on in the day is much more valid than intraday moves, which could not be certain that they're going to hold. Stocks that break out while the market has yet to make a new high can become very big winners. And they can become true leaders. And we have a whole section on leadership stocks on that you could review if you want to look more into that. But those are the stocks we want to look for. The stocks that are making a new high before the general market. Those stocks, they have the potential. They're showing their strength. Stocks that break out and make a new high for the first time in months, while the market has been roaring higher for months, may be a weaker stock that is lagging. So if you're in a situation where the market has been going up for 3 months straight, and this is a stock that's been going sideways and finally it breaks out, that stock could be lagging behind the general market. So that's something I'd be a little bit weary about, because that stock may break out and fall right back down. Let's take a look at Visa here. So on the left here you see the NASDAQ, and the NASDAQ is in stage 1 here. It bottomed here in December, and it's in a stage 1 here, and it's about to cross and go into a stage 2 uptrend. Visa is already in the stage 2 uptrend, and Visa is in the new high. So you see Visa is outperforming the general market. Visa is at a new high. NASDAQ still off its old high here. Okay, so Visa is showing a lot of strength. That's the type of stock we really want to see. We want to see when it's really showing a sign of strength, leading from the market. Next category we're talking about, you want to avoid a stock that's in an extended base. So a stock's going to enter a stage 2 uptrend. Okay, so you see with Visa here, here's the stage 2 uptrend, the 10-week above the 40-week. That's a stage 2 uptrend. Stock enters the stage 2 uptrend. The first time it breaks out in the stage 2 uptrend, that's a more reliable buy than later buys. First time it breaks out from the stage 2 uptrend, first time it breaks out in the stage 2 uptrend, it's probably going to be coming from a larger base, a larger box, a larger consolidation. And that's the big time money potential when you see that big base and the stock is breaking out and it's just entering stage 2. What you want to avoid is the stocks where they have already broken out 2 times. Now this is the 3rd or 4th or 5th time it's breaking out in the stage 2 uptrend, and everybody sees it, everybody knows it. It gets a little bit too obvious. And when you see stocks, then they go in parabolic moves and they get a very sloppy chart and they've already run up a huge amount, and you see the high volume coming in with the selling, you got to be careful because the stock could be topping. Let's take a look at the example of WWE. This is World Wrestling Entertainment here. You know the company here, Macho Man, Hulk Hogan, The Rock, Stone Cold, John Cena, all of the wrestlers here. So you see here, it just is entering stage 2 uptrend here with the blue line above the red line. The blue line is the 10-week moving average. And here's the first breakout. Heads higher, nice tight orderly action. Here's the second breakout. Now you see it goes on an extremely quick parabolic move, extremely extended here, and now becomes a very, very sloppy chart. And notice all the big selling here, the huge red bars, massive selling here. These are is the smart money here getting out of the position. And it's a very sloppy chart, sloppy, sloppy, sloppy. And it tries to break out here, and I saw this and I avoided it because I said to myself, it's way extended, it's gone on a huge parabolic move. I saw all this heavy volume here. The chart's looking sloppy. I said, this is no way I'm taking this. And then in the next weeks, you see this massive volume here. And this is just a total mess. So the whole key is that you see the big base here, and WWE's just entering stage 2. This is a breakout that you could buy. This one here, it's still in stage 2. This is the second base. You buy it here. And now when you get to here, it's way extended. You see how it's gone parabolic straight up literally over 2-3 months. You see the heavy selling coming in, the sloppy chart. Now you have to avoid. Okay, this is also V-shaped too. You see the V-shaped chart rather than U-shaped. So when you see something like this, you don't buy this type of breakout. Sometimes people get confused. They say, oh, here's a cup and a handle, and they try to buy it. But they don't see this part. They don't see that it's way extended. They don't see the heavy selling volume. They don't see the V-shaped chart. So you don't buy stocks like this that are way extended, that this is the 3rd time it's breaking out. It's sloppy, lots of selling. That's a breakout that you're going to avoid. Proper patterns. We want to see symmetrical, neat patterns with tight action, tiny price bars, tight closes, and low volume prior to the stock breaking out. When I see that type of chart, I make a note to watch that stock every day because it may be ready to really, really blast off higher. We want to see the above average volume weeks to be the up weeks, which is going to be the gray bars, and we want most of the selling weeks, which is the red bars, to be below average volume. A few above average selling weeks is okay, but we want to get the general feel that the stock is being accumulated. So let's look at WWE here. You see all these huge red bars in here. That's a sign the stock is being sold. Okay, so when you see stuff like this, a huge red price bars here, that's very scary. That tells you that there's a lot of selling coming in. And, you know, if you saw 1 week like this or something, it's no big deal. You see down here, most of the weeks are below average here, right? You see in this part, there's 1 week, but it's no big deal. But when you start seeing stuff like this, these huge red bars, it's a sign the stock is being distributed. Sign the stock's being sold off. You don't want anything to do with it. We want to see the gray bars. See, look at all the gray bars here in WWE, right? We like seeing stuff like this. The big gray bars as the stock is being accumulated. When you start seeing all these red bars, it's a sign that the stock is being sold off. It's best to look for another stock. When we look at a cup base or a cup and handle base, we want to see a U-shaped rather than a V-shaped cup. See, the problem with the V-shape is people come in and they maybe are able to buy at the bottom or they're able to buy at different points, and there's that rapid price increase. And when the stock approaches the old high or makes a new high, people say, hey, you know what, I'm going to take my profits now. So that V-shaped actions, people get a quick profit and they say, hey, I'm up, doing pretty good, let me take my profits here. So that's why the V-shaped charts are less likely to succeed, and they need a little bit of a shakeout or time to pull back. So let's look at an example here. See the V-shaped action here in SPY in 2018. 2018 December, it bottoms down here right around the Christmas holiday, bottoms, V-shaped action straight up here, and it clears this 290 range here and makes a new high and comes right back down. Because what happened is there are people who are buying it down here and they get this profit real quick and they say, let me take some profits. So that's why this is happening. These V-shaped action, people get profits real quick. They say, let me take some money off the table, and then you get a pullback here. So if you ever see a V-shaped pattern, usually I avoid it and I look for some sort of consolidation afterwards. Let's look at Baidu here. This is a chart that's very, very sloppy. We like to see stocks have neat, symmetrical patterns. We want a U-shaped pattern here. This one here is sloppy as can be. It's jagged. There's high selling here. It's just, there's no feel of neatness or order or there's no symmetry to this. It's just as sloppy as can be. And a sloppy chart like that is not a chart I want anything to do with. And you see this heavy selling in here. So if you see something like this, even though it's near its old price high, you would avoid it because it's just so sloppy and it's jagged and disorderly. And you see Baidu collapses here. And this sloppiness tells me that people are not in conviction with the stock. It's too volatile. It's best to be avoided. And you see it goes into a deep downtrend here in 2018. Tesla here, another very, very sloppy chart here. So you see here, it's just a mess. It's sloppy, sloppy, sloppy all over the place. And it's just, there's no order. There's no feel of symmetry. And it looks like a headache, and it gives you a headache. So if you see a stock like this and you say, boy, this looks like this would be a pain to own, a pain to trade, avoid it. There's no symmetry here. There's no neatness. Looking at this, you could feel the jaggedness, the disorder of it. It shows you the mind of the people who are buying it. The conviction of the masses is not orderly. It's jagged. People, they're disagreeing on it, and it's just not something you want to be a part of. And let's compare Tesla to Shopify here. See, Tesla has a sloppy, volatile chart, and this is from March 8th, 2019. And Shopify, from the same time, you see this is nice, neat, and orderly. This is what I'm talking about, neat and orderly. You see a nice, steady uptrend here. This is a jagged action over here, right? A nice, steady action here. And then you see this is sloppy and volatile and jagged and very disorderly. This is nice and calm, symmetrical here. Very neat feel to it, very calm. And you see that Shopify is at a stage 2 uptrend, starting the stage 2, where Tesla still can't sort itself out. So a picture really is worth 1,000 words. The picture shows you the mindset of the collective minds of the traders. And Tesla's chart is showing indecisiveness. It has a very sloppy, jagged feel, where Shop is showing a lot of neatness, a lot of order, a lot of symmetry, and it shows the stock is being accumulated. So now we head into 2019. We see Tesla goes into the stage 4 downtrend, while Shopify goes into the stage 2 uptrend. A tale of two different stocks. Obviously, you'd rather be in Shopify. So this section was intended to help everyone refine their buying process. Every year, I do a post-analysis of all of my trades at the end of the year. And one of the conclusions I've come to is that I always make more money when I do less trading. And what I mean by that is a lot of years I wasted money buying stocks that really were not proper setups, that weren't true innovators. And I would do the calculations and I would say, well, how much more money would I have made if I just did not make these trades? So part of the way of becoming profitable as a trader is to avoid sloppy setups, avoid buying weaker stocks with the worser charts, with weaker technicals. So that was the intention of this section, to make sure that we could refine our buying process so that we only buy the best stocks with the best setups. I hope that this section was helpful for everybody. I'll see you all next time.